Hi everybody, it's AJ speaking. Today is Sunday after the 4th of July holiday. A bunch of key things happened. The big beautiful bill was signed into law, affecting Tesla's US vehicle sales, also importantly credit sales, a couple of other things, and then obviously Elon announced to create the America Party. So in this short video I want to cover the effects of all these new drivers. The big beautiful bill, a lot of the key provisions have been known for several months, and it's widely known. Trump campaigned on eliminating basically pretty much all support that is EV specific, and do away with the SAF credit sales. Tesla has a material gross profit inflows from SAF credit sales, so that has a meaningful impact on earnings. So with that out of the way, let's get right into it. Here, just on the starting slide, you see the revenue outlook. You can see down here, I expect 11% decrease this year, and then next year we will see a nice recovery, but this will be predominantly driven by the second half of 2026. So there are a couple of tough quarters ahead. This is just a breakdown. I'm not going to go into all these details in this presentation because this would take too long. Gross profit, this is where the loss of credit sales really hurts. Credit sales do not generate a lot of revenue, but because they're pure profit, they have an outsized gross profit impact, and this is what you see here. Now I'm expecting a 19% drop in gross profit this year. Next year, a recovery and a very strong gross profit growth thereafter from all of the AI products. But again, a couple of tough quarters ahead. Here's just a gross profit breakdown. Currently 2024 full year, Tesla was 80% gross profit automaker. I expect Tesla to move away from auto in the next few years, and in 2028 full year basis, gross profit for the first time from auto will decrease below 50%. Then just how this develops over time, I recommend look at my thread on X discussing this in detail. Operating expenses gonna increase quite materially. I expect that Tesla will have to ramp up even more comp packages in all the AI related teams, because there's a huge talent war right now going on, and Tesla will not be immune to that. But this is all reflected in my forecast, and this is also already reflected in its operating profit outlook, and it's partially a meaningful driver why it's coming down so much. So I expect now a 50% drop in operating profit in 2025, a significant rebound in 2026 as high margin or software related revenue comes online, most important of which FSD subscriptions. I expect as Tesla approaches the point where you can take a nap in the car, FSD subscription will significantly increase, but the primary driver will be then in the second half of 2026 the scaling of the Cybercab network. This will be the first real needle mover. And then so bottom line, adjusted shareholders net income is the number you want to look at, because this is the number that relates directly to diluted EPS, which is the most important valuation input in Tesla's case. And you can see I forecast a 30% decrease in 2025, then a rebound in 2026, and then strong growth thereafter, very strong growth thereafter. Then the EPS outlook, I forecast for Q2 43 cents. So Q2 is not affected in material ways by the big beautiful bill. Q3 will likely even benefit in auto sales in the US, because there will be customers that will try to secure the tax credit before it goes away. So that there will be probably strong US sales numbers. But then there will be probably US sales weakness in subsequent quarter, which is Q4. So overall, Q3, Q4, kind of a wash with a subsequent permanently lower demand level relative to quarters where we had tax credits, obviously. So when you look at these EPS numbers for 2025, they're not very exciting. 2026 then recovery, and then thereafter quite strong growth. And then so what does this mean in terms of valuation? the same slide, just turning a quarterly EPS into in a rolling 12 months metric forward looking, because we need this for the next step, which is this. This is like the smoothed out earnings curve, always on a 12 months basis. This is what you need to project a smooth share price. But before we can do so, we need a multiple, and this is what this analysis does. This slide looks at the implied true multiple from Tesla, which is the gray line down here. And as we run out with next 12 months unreported real quarters from Tesla, we need to supplement these 12 months periods with estimates. This is this lighter blue number. And then once we run out of next 12 months real Tesla reported earnings, we need to add, we need to base it fully on estimates, and this is what this darker blue number shows. And then when you run a median from today's perspective on these multiples, you actually get to 160 times based on the now revised outlook, affecting, including the triple B bill, the big beautiful bill, and latest demand developments in various international markets. So you can see there's a very high multiple, and these green lines just indicate the one standard deviation up and down, and the red lines 1.5 standard deviation. So outsider moves up and down from the perspective of the median multiple over the last 12 months. And this is why these prior periods are also far outliers, because in prior periods the multiple was not as high all the time. With that out of the way, let's just bring in some market perspective. So this is a slide. I did not make the underlying slide. I took this from a JP Morgan Asset Management analysis. Saved me a lot of time, but if I did it, I would basically create exactly the right same curve. But bottom line is, what you can see is that current market valuation levels are quite high. So you can see the market trades at end of June at 22 times forward PE. By the way, forward PE, NTM, it's all the same thing, unless specifically defined otherwise. A forward PE can also be a next 2 years, or also called next 24 months. It doesn't mean earnings over the next 24 months. No, it means 12 months earnings 12 months from now. So, but anyways, this is a less frequently used multiple. I use it all the time in stocks like Tesla, but let's stick with the standard approach to not make it too complicated. But bottom line is, what you see is marketed to buy the S&P 500 right now, at least based on historical valuation levels, is quite expensive. When you look at this chart, in the last 30 years, there have only been 2 periods where the multiple held for extended periods or ever exceeded 20 times was during the dot-com bubble. And when you look closely, there were quite wild swings in market valuations. And when you look very closely, you can see that it was very rare that an over 20 times PE was maintained for much longer, what we have now seen. So when you look at this, we have now, and by the way, these are 2-year clips down here. So half a distance is already 1 year. Keep that in mind. So when you look at this, in April we almost touched back to 20, just above, and the last time we touched on 20 was beginning of 2020. Was around mid 2024. So the point is that we have been in above 20 PE territory for quite some time, and as I just said, it's a very rare occurrence for the market to maintain that level for much longer. So, but we'll see. I'm not like a beer pumper and suggesting you should exit all your equity holdings. No, I just want you to think maybe twice about what type of leverage or derivatives you're using, and whether you want to add even more equities at this point. So then we continue on looking at Tesla, and now we need to look at something that obviously there is no standard approach to how you can try to quantify that. But when you look at this analysis, so basically, what is this, first of all? In this analysis, I tried to derive what could be the political impact from Elon creating a competing party with both the current party in power, the Republicans, and the Democrats. And what I thought, and of course there is no perfect approach to this, but I think some reasonable approach is better than no approach. And what I thought might make sense is to do the following. So here on the far left, we look at the implied forward multiple of Tesla just before it was clear Trump was winning. And if you remember, until very late, it was not clear at all. Most people thought Kamala would win, but anyways. So and keep in mind, the Democrats were widely considered hostile to Tesla, and it obviously was in some shape or form baked into Tesla's share price. So keep that in mind. So just prior to Trump's election win, the Tesla traded around 99 times. So this was in early November 2024. Since then, right now it's early July 2025, the market appreciated, it's wrong way to say it, the market's valuation level increased by about 10%. So it's not the S&P 500 index I'm talking about increased by 10%. No, this is actually more. I'm talking about the valuation level, and the valuation level I'm talking about is these multiples. So we moved from around 20 times to 22, so it's a roughly 10% increase. So this is what you see here. So it's 10% over the 99 times multiple. But then obviously that's the market. And when you do a simple beta analysis, you can quickly find out that Tesla trades at roughly 2.5 times beta, which means when market does a 10% move, you would expect Tesla to make a 25% move. So we need to account for that, and to avoid double counting, we can't just add another 25x. We need to remove the market move, and then the Tesla move less the market move, the net move above the market. Effectively, this is this third bar. And then, of course, the political premium. So how do we get to the political premium? What I thought makes sense is we look at the implied Tesla multiple just before all the Trump feuds. I mean, the first feud started when Elon posted about Trump potentially being on Epstein list. First big one. Second one happened a couple of weeks later when he then clashed with Trump and the Republicans about when Elon complained about the debt, and the big beautiful bill would do nothing about reducing the debt, which is correct. And then of course Elon's most recent announcement creating the America Party. So to get to an undisturbed multiple, you need to go back to before all that happened. And this is what I did, and the multiple at that time was around 149. So my approach is based on, okay, if we take into consideration what Tesla was, we take into consideration the market's appreciation and Tesla's implied appreciation, and then look at, okay, what's the gap between the last undisturbed Tesla multiple. The gap must be the political premium. So basically the unwind of the hostility during the prior administration. So basically from removing that political overhang, which, if you remember, caused Tesla's being sued all the time, SpaceX being sued all the time, and a bunch of other things, other attempts to undermine Tesla. Investors rewarded that with a 25x. Sorry, not 25x, with a 25 times, what's the right way to express it? So this is basically a PE multiple. So the PE multiple increased by an additional 25 times earnings. I think that's the correct way you can say it. But then obviously this analysis is about, okay, what's now the unwind of that benefit? And the unwind is basically we have to remove that implied premium from the multiple, and then we go back from the multiple at the time, from 149 to would be 124. But since the undisturbed multiple, the multiple in Tesla actually increased further, and the primary reason is that first of all, the market performed quite well during that period in the last couple of weeks. Plus, Tesla's earnings outlook weakened further, while the stock didn't really respond to it very much, and this basically then creates even higher implied multiple. I expect this to be priced in the coming weeks. I hope I'm wrong, but analytically this is where I come out. So long story short, where do we come out? And so I just go very quickly through the following things. This is then the implied share price corridor without excluding the political premium that we just worked out. This is then the implied share price targets over the next 12 months, so next year July, and then July 2027, so that they're quite high, but again excluding political fallout. And this is the big question. I don't know. I don't think Elon will abandon his plans to create another party. For him for a long time, it's unlikely. I mean, there's always a chance he puts it at least on ice. For example, right now, supposedly there's a meeting between Trump and Elon. Things can change very quickly, but I just want to show you both scenarios. So, and you can decide what you think makes more sense. Right now, my base case is that we likely go towards the direction of a third party, and because I don't think Trump can make a deal that would um, address Elon's primary concerns, and Elon's primary concerns are driven by by the huge debt crisis the U.S. is in right now, and which is threatening the not only the stability, the financial stability, but also the competitiveness of the United States in various complicated ways. Right now, some of the current administration's policies, I think, weaken the U.S. in certain key AI areas, in particular in relation to energy production, where China just takes a huge lead, and the latest cuts in the BBB bill do nothing to boost U.S. energy production, unfortunately. So with that out of the way, so this is just a zoomed-in version of the prior. Again, this does not include political fallout assumptions. You can see, so the gray line is kind of the trading range that you should expect most of the time, and then green and red, more of the outlier trading ranges based on this methodology explained. And then now it becomes exciting, drum roll. This is then the analysis, including the approach I showed you earlier, where we back out a 25x premium in the multiple. And you can see how all these, if I flip back and forth quickly, you can see how this is moving. Obviously the gray line, the share price, historical share price is not moving, but everything else is moving because we are haircutting the multiple by 25 times. And so this is basically a parallel shift of all of these implied curves. And obviously, you might notice here's like a bigger spread. This is because these are higher multiples, these are lower multiples, and in relative terms, if you take off 25x, this has a bigger impact on a smaller multiple. That's why you see the spread emerging. So the bottom line is that based on this analysis, in which I try to capture everything, the earnings outlook, which comes down now, also competition challenges in important foreign markets. I talked about this a lot before, and a bunch of other things. It looks like if investors believe there is basically a scenario on the cards and they price it in to nearly 100%, like a scenario similar to the prior administration, if there's a hostile administration, we have to see whether this is what's going to happen. But then currently the stock would be overvalued. So you can see, so the last closing price before everyone went into the long July 4th holiday was $315, and this would be right now outside the implied trading range, given lower earnings outlook, but more importantly, a multiple that would come down. That's the end of this presentation. I hope this was helpful. If you like this type of investment research, consider following me on X or even subscribing to my research. Thank you much. Bye.